The world's first digital industrial company is transforming the portfolio.
My name is Sophia Gesmir.
And my name's Ryan Souza, and we're here today to give you a brief overview of the company General Electric.
To begin, we will look at the history of the company starting in 1892, when a merger between Thomas Houston and Edison General Electric. Edison General Electric was originally founded by Thomas Edison, but shortly after the merger, Edison retired after a long, successful tenure with his company.
As you may have guessed, General Electric was one of the first commercial electric companies in the world, thanks to Thomas Edison's invention of the light bulb and his harnessing of electricity. From here, General Electric moved into the appliance market by selling revolutionary devices such as light bulbs, elevators, motors, toasters, and a whole load of other appliances.
In 1920, GE invested in its first cross-market venture by investing in RCA, a radio broadcast company with AT&T. Unfortunately, GE was forced to sell off its RCA venture as a result of an antitrust ruling.
50 years later, in 1980, GE had reached $25 billion in revenue from its plastics operations, consumer electronics, nuclear reactors, and jet engines.
Not even a year later, GE's world was turned upside down when Jack Welch, heralded as one of the best CEOs in his time, became president. Welch dropped many ventures and operations that weren't performing and kept the ones that were. He also had this philosophy when it came to keeping and firing managers.
Not soon after Welch's rise to power, GE decided to go in the direction of finance and investments with a new operation, GE Investments. GE's capital finance and investment operations would end up boosting GE into the position that they are today.
Speaking about where GE is today, they are ranked in Forbes 500 as the 8th best company in America. They command over $100 billion in revenue each year and are almost always a top-performing company in America and in the world.
Their revenue for this year finished off at about $117 billion. Compared to its closest competitor, Siemens AG, it is almost $40 billion higher than their 2015 revenues of $72 billion. But don't let this stat deceive you. The overall trend of the revenue stream for GE has mostly been on the decline in recent years, while Siemens has been relatively flat.
Now looking to the ratios of these two companies, the difference isn't all that different. General Electric and Siemens AG both have adequate assets to cover their liabilities. GE's current ratio is 1.61 and Siemens is 1.3. This means that GE can cover their liabilities a little over 1.5 times, while Siemens can cover their liabilities 1 1/3 times.
Moving down the list, we can see that Siemens has a better return on assets than GE, with a 6.47% versus a 1.08%. This shows that Siemens' profits are more significant when compared to their overall resources or assets.
Next, we have the turnover ratios for each company. GE's turnover ratio is 4.11 and Siemens is 3.33. This means that GE can turn over their inventory faster than Siemens. This should be taken with a grain of salt because GE is just substantially bigger than Siemens and therefore has a large customer base.
The other pertinent turnover ratio that is often considered is the asset turnover ratio. GE's asset turnover ratio is 0.21 and Siemens is 0.67. This ratio is a measure of the company's sales relative to its assets. A higher ratio typically indicates high efficiency with which a company is deploying its assets in generating revenue.
Lastly, we have the debt-to-equity ratio that is a direct indicator of the company's debt to the company's equity. It is often a common indicator of a company's financial leverage. GE's debt-to-equity ratio is 1.5 and Siemens is 0.77. A high debt-to-equity ratio generally means that a company has been aggressive in financing its growth with debt.
Next, we'll move on to the common investor ratios, and then finally on to a clear recommendation. The first common ratio is the earnings per share ratio, or EPS. GE's EPS for 2015 was a negative 61 cents, and Siemens was a positive $9.83. GE's EPS was negative as a result of the net loss that they posted in 2015.
The other common ratio that investors use is the PE ratios, or the price-to-earnings ratio. The price-earnings ratio is the ratio for valuing a company that measures its current share price relative to its per-share earnings. The price-earnings ratio indicates the dollar amount an investor can expect to invest in a company in order to receive $1 of that company's earnings. GE's PE ratio is 17.14 and Siemens is 14.1. This generally means that GE would be a better investment based solely on this ratio.
Unfortunately, the PE ratio isn't the only thing to come into play when determining to invest in the stock or not. All of the ratios we discussed are actually playing a pivotal role in whether or not to invest in this company or not.
Our recommendation is to say yes to investing to GE, mainly because their revenue was down this past year as a result of a major restructuring and the company deciding to move in a different direction. The drop in revenue could provide a great opportunity for investors to scoop up a GE stock that is lower than usual.
This is the strength of GE.